In this video, I'm using problem 18 to discuss income tax footnote and how to read the income tax footnote and how to utilize the information disclosed in the footnote. Because to understand the company's tax is very important to understand the company's business, their strategies, and prospective performance. Before we start, let's first review some formulas. As we know in the prior video, deferred tax assets is generated when the tax owed is greater than tax expense. In other words, the deferred tax assets is created when company pay more tax than it actually incurred in the financial reports. And also this condition equivalent to this when taxable income is greater than income before tax. So we know income is determined by the difference between revenue and expense in the financial reporting, and revenue and deductions in the tax reporting. Because the differences between tax law and financial reporting standards, so the tax revenue and the financial revenue are different. And deductions for tax is different from the financial expense. So that's actually the reason caused the company to have different taxable income and income before tax, and finally, difference between tax owed and tax expense. So this is a circumstance the company will recognize the deferred tax assets, or in other words, the deferred tax assets increase. Okay. And if this is if we assume the company continues this trend in the future, that means keep the taxable income is always greater than income before tax. That means in the future, if the tax owed is always greater than tax expense, we can expect the deferred tax assets will be accumulated, will be increasing until the company's this trend discontinued or reversed. We will observe the deferred tax assets will be diminished, decreased. So this also applies to deferred tax liabilities. Okay, when deferred tax liability is created, when the tax owed is less than the actual tax expense the company incurs. In other words, when taxable income is less than income before tax. What makes the difference between taxable income and income before tax? Yes, the difference between tax revenue and financial revenue, tax deductions and financial expenses. So you can see the directions is kind of reversed for deferred tax liabilities. Okay, so if the company expect certain item makes the taxable income is less than income before tax for the future, we can also observe deferred tax liability will be accumulate or increase. Otherwise, if the trend reversed, we will also observe the direction of this will be reversed. And finally, the deferred tax liabilities will be diminished or reduced. Okay, in the company's tax footnote, you can always see there is a net deferred tax, can be either assets or liabilities. It can be deferred tax assets or deferred tax liabilities. Depends on which one is greater. So the company always shows the net amount between deferred tax assets and deferred tax liabilities. Okay, let's go back to this example. Okay, so this is a footnote, text footnote for prepaid legal service, PPD. The bottom line is a net deferred tax liability. Okay, so the reason is for a certain year, for example, 2008. Okay, so the deferred tax liability, 15,771, is greater than the deferred tax assets. So the net amount is deferred tax liability. We use a bracket to indicate this is deferred tax liabilities. So this is also same for the 2007, because deferred tax liability is still greater than the deferred tax assets. So the net amount is still deferred tax liabilities. And in this footnote, you actually observe there are many different factors results in the deferred tax asset and deferred tax liabilities. For example, so there are 3 items here. Basically, this is 3 items, this is an area. There's a difference between tax law and financial reporting. So that's actually kind of reasons cause the company to have deferred tax liabilities. And also this is an amount. Because deferred tax liability is a permanent account, so they can accumulate. Okay. So the number here is represents the balance of deferred tax liability accumulate in the sense the company start preparing their financial statements. We can observe, comparing with prior year, whether there is an increase or decrease. So the 15,771 represents the total of these 3. So in this case, it shows us there are 3 factors contribute to the deferred tax liabilities. Again, we can also find 3 other factors summarized here. They are contributors to the deferred tax assets. Okay. For each year, the company still, again, will have the difference between tax reports and the financial reports. So there must be the change in the deferred tax assets and deferred tax liabilities. What we observe here is deferred tax liability basically increased. Right? From 2007 to 2008, it increased like 450 something. And deferred tax assets also increased, right? Like 60, well 50, or 60. So the net amount is for this year, the company actually deferred tax liability increase like 385. And we can find the 385 here. Okay, so that actually shows the change of a net deferred assets or liabilities. Okay, so what's the meaning of current and deferred? So the current represents the tax owed in current year. Okay. This is tax owed. And this is actually the tax expense. Okay. And this is represent the difference. So in this year, we know the company paid 36,840 cash tax to the IRS, while in the financial statement, tax expense is 37,225. So let's go back to the notes, right? Actually, we observe the tax owed is less than the tax expense. So we know that there will be a decrease deferred tax liabilities. Okay, that's what we observe in the footnote. But we also learn the final increase 385 is caused by multiple factors. Right, so this is just the total increase, but we know lots of details, right, in here. Now let's start working on this question. I hope you read the background information here to know something about the business. Question A. So it asks us to make a judgment which one is greater, income before tax or taxable income, just based on the information given. Right? So actually it is simple, right? Because we found in 2008 tax owed is less than tax expense. So let's go back to the notes. Tax owed is less than tax expense. So taxable income is less than income before tax. Right? So that's the first question. For 2008, that's for 2008. For 2007, actually, the result is actually opposite, because here the tax owed is greater than the tax expense. So when tax owed is greater than the tax expense, we can conclude taxable income is greater than the income before tax. Question B. When we make an adjustment to the statement of cash flows, okay, I just use the example of 2008 as the example. Okay, in 2008, the company deduct 37,225 from its revenue to calculate net income, and the company only deduct 36,840 cash from the statement of cash flows in the operating section. So that means you deduct more expense than your cash flows. And we know when we prepare a statement of cash flow by using indirect methods, we start from net income. Right. So you deduct more in the income statement. Now you prepare a statement of cash flow, so you actually should add the difference back to the net income. So in 2008, the company should add back. So the result for 2007 is opposite. So we should subtract. The reason is when you prepare income statement, you deduct less than the statement of cash flow. So you should subtract the difference. Okay, these are very, the question we can answer directly, from the disclosure or footnote. Question C. So this tells us the company recognizes the premium as revenue in the tax report earlier than the revenue in the financial reports. So that will give us that the company is going to have the taxable income will be greater than income before tax. Why? Because according to this example, the company recognized income earlier in tax reports than the financial reports. Okay, so when the taxable income is greater than the income before tax, we know that's actually a generation of deferred tax assets. Right? So this also answer our questions. So deferred tax assets. We can also find, this item, deferred revenues and fees, right? Deferred tax assets. Actually, the reason, as I said, when company collect the premium from customer, the tax law allows companies to recognize the premium receipts as revenue, but financial accounting standards will delay the revenue recognition during the period of the coverage. Okay. So you can also answer for the question. We can also observe the change from 2007 to 2008, right? So here is a decrease in the deferred revenue and fees for total deferred tax assets. That gives us an impression that the company is experiencing maybe a reduction of the sales. So company collected less premium than before. So this kind of caused the deferred tax assets decrease. Okay, so that means the trend is kind of reversed, not deep, but a little bit. Okay, so this gave us that impression the company is experiencing the sales decrease. Question E. Let me use the original file. And we know for the depreciation, there's a difference between tax law and the financial reporting. Tax law allows company to use different depreciation methods from the financial reporting. For example, most companies use straight-line depreciation for financial purpose, but accelerated depreciation methods for tax reporting. And this will cause the company will incur higher depreciation deduction than the depreciation expense in the financial reporting. Let's just compare the, use the this figure shows us. So double declining balance is an example of accelerated depreciation. So if the company use double declining or accelerated depreciation for tax reporting, it will incur higher depreciation than the financial, right? At least before this point. After this point, the straight line method is greater than the accelerated depreciation. So, because of this, the accelerated depreciation will cause the company to have larger deductions than the financial expenses. This will cause the taxable income is less than income before tax, and finally generated deferred tax liabilities. That's why we observe, let me use this tool. Okay, that's why we observe that the property, plant, equipment is a factor contribute to the deferred tax liabilities. And we also observe here there is increase. Okay. So the increase actually indicates the company keep purchasing new equipment. Right? So if the company keep purchasing new equipment, that means the company can keep the trend to accumulate deferred tax liabilities. Otherwise, the trend will be reversed. And we know if company invest in the property and equipment, that's a sign the company, expect their future demand from customer should increase. Okay, so that's something we dig from the income tax disclosure. That's for question E. For question D, this is another difference between tax reporting and financial reporting. Tax reporting allows company to deduct cash costs. Okay? But the financial reporting, the cost will be expensed, later on, not immediately when the company pay for the costs. So this will cause the company to have a tax deductions will be greater than the financial expense. It's similar to the property, plant, and equipment example. Again, it will generate deferred tax liabilities. That's why we also find deferred member associated service cost is in the deferred tax liability part. But we observe there's a decrease, right? So the decrease actually indicates the company pay less costs. So that is another indicator the company's sales decreased, right? Because this expense or this cost is associated with acquiring new customers. So if this decrease, that means fewer customer was acquired. So that's an indicator of sales decrease. So for this question, it's kind of hard to make a judgment what happened in the company because property, plant, equipment, this factor support the company is expanding. But these two factors and what we discussed before, deferred revenue fees, this actually shows us the company's sales decreased. It's kind of a conflict between these two informations. However, the income tax footnote provides us more information to help us understand business and what happened in the business. Okay. And to resolve this conflict, probably as a financial analyst, you should read more information from other resources. Okay. It also answers the question of F.